It's your boy Crypto Blood, and welcome to another episode of My 2 Cents. Today we're going to be looking at the Treasury Department looking to create a new form of debt. It's been rumors for many years about the Federal Reserve or the Treasury Department creating a 50-year Treasury bond or a 100-year Treasury bond, but they're actually creating a 20-year bond, and we're going to take a look at some of the details on that out of Zero Hedge. I think personally just more can kicking and more opportunities for, like the foreign countries to fill the gap on that yield curve, right? The more debt instruments you now offer, that's just more opportunity for them to buy our debt. So that's how I look at it. We'll see what Zero Hedge has to say about that. Also, the Fed about to trigger a $35 trillion U.S. housing market crash, and we're going to see the details on how and why this may be happening very soon. And with all this nonsense that the Federal Reserve is conducting right now with the repo rates, and in my last video I told you they're looking to extend this repo operation to hedge funds. If this happens, ccn.com is saying that they actually may be giving the election to Bernie Sanders. I don't think so, but we'll take a look at what they have to say about this, though it is definitely a move that would shaft the middle class and the 99 percenters. Basically it will definitely shaft them and give them the short end of the stick yet again. But will we be smart enough this time to wake up? So we'll take a look at all of that here in a second. But before we start, if you guys find these types of videos informative, make sure you like, share, and subscribe, and click that bell to receive more videos like this. Markets haven't opened yet at the time of recording, but as I told you on Friday, Dow Jones hits another 52-week high. We've got Dow Jones closed on Friday at 29,348 bucks. I'm telling you guys, at this pace, we will see $30,000 Dow Jones within the next 2 weeks, I believe. Easily. Gold starting the week off slightly up. Not much though. Up 70 cents right now to 1,561 bucks. Looks like it's trying to make a move back toward its highs, but it came well off those tops at 1570, and it pulled back as low as 4% off those highs. And Bitcoin dropping off a cliff over the weekend. Looks like it's building a base now, and we may see something like a Bart Simpson maneuver where we head back up in a linear fashion. That is one unique characteristic of cryptocurrencies, those type of sporadic up and down binary moves. So that may be the case here as well. We'll have to see. But I want to go over an article that I found out of thestreet.com, and it just talks about what is the next Minsky moment for the markets in 2020. And they go through a list of possible Minsky moments. Impeachment, they talk about oil, but this particular article settles on the fact that they believe that earnings will be that Minsky moment this go around in 2020. And he said the only factor that should matter to those interested in valuation is corporate earnings. So this market has shown the ability to shrug off any bad news and spin negative into positives. But earnings misses are harder to ignore. So if we see a company like Target, which is a bellwether in the U.S. consumer department, that would definitely put a spotlight directly on Amazon. Amazon shares have lagged NASDAQ over the past year after an amazing run in the prior 5. So the editor is saying that we need to look at what Amazon shares will look like in this first quarter. Same thing for Tim Cook and Apple. It says the company has produced no meaningful growth in iPhone shipments. A figure that is no longer even reported for the past 4 years. The market has bid up Apple shares in anticipation of strong growth for services, right? Like the launch of the Apple TV Plus and ancillary products like the AirPods, which I talked about last week, grossing them over $8 billion, which I was very shocked about. Didn't know that particular stat about Apple and the AirPods. But you can't, I think that was like a one-off thing. I don't see them being able to continue to sell billions of dollars worth of earbuds, right? Or AirPods. This is not something that you'll need to upgrade every year. And I think even an Apple phone is outrageous how they spin out these new Apples every year, practically the same damn phone, but they iterate slightly on these phones and ship them out like it's the best thing since sliced bread. This is even more of an issue for AirPods. You're not going to be able to hook, line, and sink consumers to buy a new set of AirPods every year. So to me, Apple's got to somehow find growth somewhere else. And of course, we can't talk about earnings and bubbles without talking about Tesla. Their 2020 vehicle estimates for Tesla around 360,000 to 400,000, equal to Elon Musk's guidance for 2019 sales, which finished at roughly 367,000. And so when Tesla actually gets around to setting a date for its fourth quarter earnings report, it will be a pivotal moment for that stock price. Because we have Oppenheimer giving a new target of 600. I've even seen analysts out there talking about $800 Tesla per share, which is just insane. And maybe one day I'll do a full video on just the shadiness surrounding Tesla and its accounting practices. Very, very shady if you knew exactly what was going on there. Maybe I'll do that one day. But yeah, earnings, it may be the Minsky moment for sure. Though even this editor says that he doesn't believe that this is going to be a true correction because we have the Federal Reserve propping up these markets. And speaking of Federal Reserve propping up markets, CCN also thinks that they're going to give the election to Bernie Sanders if they continue on their path. The Federal Reserve continues to make wealth inequality worse, which could hand the 2020 election to President-elect Bernie Sanders. And as I've noted in the past My 2 Cents video, the Federal Reserve is reportedly considering loaning money to hedge funds for them to make risky bets. Fed policy have greatly benefited the rich and led to massive wealth inequality. And so Bernie Sanders has been rising fast as a 2020 president contender, and recent polls suggest that he's doubled his lead over Donald Trump and would cobbler him in a head-to-head election. Interesting. It's increasingly clear that Sanders has a viable path to the presidency, and he owes it all to the U.S. Federal Reserve, they say. The U.S. Central Bank is reportedly considering lending money directly to hedge funds to avert repo market crisis. The Fed's aggressive stance suggests that the recent liquidity injections in the repo markets have not been enough. It also suggests that at least one big hedge fund is in a precarious situation, and the Federal Reserve is just going to give them free money in the form of a preemptive bailout. And so the Federal Reserve is setting a morally hazard precedent. Hedge funds will be encouraged to place high-risk bets as they will have nothing to lose. This safety net provided by the Fed will further increase the gap between rich and the poor, just like it did during the Great Recession. I mean, it's just plain and simple. Look at these repo injections. Every time they hit the repo markets, the stock market just continues to rally higher each and every time. It doesn't miss a beat. And I've said this before with President Trump, repeatedly boasting about the stock market performance under his presidency, but artificially inflating the asset bubble only helps the wealthy. And I totally agree with that. According to Goldman Sachs, 50% of stock market wealth is just owned by the wealthiest 1%, up significantly from 39% in the late 1980s. These pumps will only widen the already huge gap. And we know that they won't let the rich get their heads handed to them. So they're going to do anything and everything to keep this stock market propped up. And it goes on to say here, while American consumers are drowning in trillions of debt, the Federal Reserve's money printing machine has created a massive asset bubble that has helped the rich get richer, with income inequality jumping to the highest level ever recorded. So here's my take on this situation. I have to disagree with the article. I think Trump still is going to win. They can't beat Trump. Bernie Sanders can't beat Trump in a debate first. And Bernie Sanders is going up against a lot of statistics that show this is not going to be the year for him. Now, my concern is that after Trump's second term, you're going to see a market correction and us start to go into our recession. I think we'll start to have a recession either during his term. I think it has to be, and actually I think it's going to be in 2021. So after he's in, you know, he's going to be left hand holding the bag. The whole thing that he's been boasting about for the last 4 years or 3.5 years now is going to come back and haunt him. And so I think the recession starts under his second term. And then from there, people will be very upset at him, at the Federal Reserve, for all the nonsense that they're going to continually try to do to prop this thing up. But I believe that you're going to see a socialist movement, like the pendulum is going to swing toward the socialist side. And that is not the solution. That is not the solution. That is a dangerous, slippery slope to go down. But the majority of Americans don't understand what socialism really means. It really means that it freezes the people who have money. It freezes their net worth. Their wealth is frozen right there in a socialist society. And essentially it freezes everyone. So wherever you are, you won't be able to really have upward mobility. As an entrepreneur, you're going to be stuck where you are. That's no good. That's not the American dream. You know, the American dream is to go from rags to riches. And you won't be able to do that in a socialist society. It just won't be possible. So I'm not saying that capitalism is the end all be all. There are many flaws with capitalism, and I think there's some type of system we can come up with that is a hybrid of many ideologies. But I do think Trump is going to get in a second term. He's going to slaughter whoever he's up against in the primaries. It's just not even going to be a competition. It's just not. He has a good economy behind him. He has good unemployment stats behind him. I mean, he has so many things going well for him that, and in addition to that, the incumbent normally wins. So all of those things stacked up against anyone coming out of the Democratic side is just going to be almost impossible for them to win. And that's why you see the Democratic Party with all these, and it shouldn't be. This is a very low period in America, in my opinion. We see the Democratic Party using impeachment as a political tool, which is sad. It's sad they have to go that low. They couldn't get him on the Mueller report. They spent over $40 million of taxpayer dollars to find out nothing happened. The Steele dossier, all lies. Everything they have got against him have been lies. So we'll see. We'll see what happens. But what I want to show you guys is this new type of debt that's being issued here. It's a 20-year bond. And so this happened actually on late last Thursday. The Treasury announced the outcome of the process when it unveiled plans to issue a 20-year bond. As Zero Hedge has periodically reported over the past several years, the Treasury had explored a range of potential new debt products, including 20, 50, and 100-year bonds, as well as floating rate notes linked to the secured overnight financing rate, all with the goal of expanding borrowing capacity to finance the soaring federal deficit at the lowest possible cost. The decision to pick the 20-year bonds is not surprising in light of persistent pushback by the primary dealer community against longer durations. Furthermore, the fact that the Treasury previously issued 20-year bonds means it is familiar with the mechanics and market demands of it. And so since 1980, they've introduced actually only two new products. TIPS and FRNs permanently canceled two products, which was the 4-year and 20-year. They also canceled and subsequently reintroduced three products, 3-year, 7-year, and 30-year. So they've been kind of going all around with these products, these debt products. And it says, as part of its consideration of new products, the Treasury gathered feedback on these potential products from a large and diverse set of market participants. Curiously, while choosing to ignore 50 and 100-year bonds, despite the tremendous demand these issues have seen across Europe. And so the new U.S. 20-year security is set to offer a notable premium over comparable notes abroad, presuming it slots somewhere between 10-year and 20-year yields, currently at about 1.81% and 2.26%. Japanese 20-year bond yields are about 0.32%, and German ones are 0.07. So there you go. If the 20-year bond comes out at around, let's just say in between 1.81 and 2.26, that is leaps and bounds better than anything else out there, and hence why U.S. debt, I know we like to think we're the worst in the world and we have so much debt and all of that. Yes, we do. However, we're the best house on a bad block. U.S. debt is in demand the most ever. So don't think that this gravy train is over just yet. They're going to continue to do things like this. Create 20-year bonds. They'll even go further. They'll do 50 if they need to. They'll do 100-year bonds if they need to. They'll continue to issue new types of debt to keep this game going, and it won't be over. I still think, I'm not saying that we won't have a crash in 2021, but it won't be the end game. It will not be the end game. This thing is going to die a slow death, in my opinion. You guys give me your thoughts on that. Interesting to see 20-year bond being brought back into circulation. And lastly, we've got out of CCN as well, that poses a question about the Fed triggering a $35 trillion U.S. housing market crash. And let's see what they say about this. And so UBS predicts that there will be 3 rate cuts this year alone. So further rate cuts could encourage unnecessary risk taking. Interesting. So they're thinking, from the looks of it, they believe that the next housing crisis will be started simply because there will be easy money to buy another house. So therefore, we've got 2007 all over again. 2006 all over again. So it says the U.S. housing market apparently enjoyed a terrific time in 2019 as home prices rose due to tight supply, but investors shouldn't ignore the anomalies that are casting a dark shadow over the market. And so it says Zillow estimates that the U.S. housing market was worth $33.3 trillion in 2018, up 6.2% on the year and 49% since 2012. But home value growth fell close to 6-year lows in 2019, with Zillow projecting a much smaller increase of 3.8%. But what's surprising is that the U.S. housing market actually lost steam last year. There were favorable factors, that should have led to much stronger increases in home prices. Bottom line is that the rate cuts were not enough to give a nice boost to home values last year despite a supply crunch. So if the Fed decides to cut rates further in 2020, it could trigger a major market downturn. Dallas Fed president said recently that a lower interest rate environment has encouraged investors to buy risky assets, he told Bloomberg Television in an interview. The Dallas Fed president added that investors might be thinking that the Fed has set a high bar for future rate hikes. In effect, they probably believe that lower interest rates will continue, and UBS's report actually adds to that belief. But the problem is that even a favorable interest rate environment may not save the U.S. housing market. So essentially, there are two scenarios that can pan out or play out. We can have weaker wage growth and emerging cracks in the job market, forcing potential buyers to think twice before purchasing, or we can have where the interest rates go so low, if they do 3 rate cuts this year, it's going to foster more speculation, right? And so people will buy more expensive homes because the interest rates, the money is cheap. And then when things slow down, it will just amplify the housing crunch, right? So we'll have to see what happens, but I definitely agree with them that the Fed is not helping the situation at all with all of their trickery in the repo markets, and it's going to end very, very badly. And it's going to be like holes in the bubble all over the place. They won't be able to plug everything. That's the problem. They've distorted the market so much, they won't be able to plug all the holes at once, and it's just going to all crumble. Now, I'm saying that that scenario is not anytime soon. We'll have, a recession coming up, but the recession will be managed by unprecedented moves by the Federal Reserve. Believe me, they will make sure they will pull all the stops out. They will pull all the stops out for this one. So we'll have to see what happens. That's my 2 cents on the topics. Let me know yours in the comments below. If you found this video informative, make sure you like, share, and subscribe, and click that bell to receive more videos like this. I'm out of here, people. Holla.